Is SCHD in trouble? That's the question floating around right now. Some say yes. Why? Because it's only up 1.86% this year. Meanwhile, the S&P 500 is up 5.8%. DGRO is up 6.9%. FDV about 7.6%. Numbers like that make people restless. But here's the thing. That's the wrong question. The real question is, did SEHD ever promise to beat those funds every year? No. Its goal is different. It's about steady dividend growth. It's about quality U.S. companies with proven track records. It's about weathering storms without falling apart. The problem is, many investors treat it like a racehorse when it's actually a workhorse. And if you think every ETF in your portfolio should beat the S&P 500, maybe you're not building a portfolio at all. You're just chasing headlines. Chapter 1. What SEHD actually is. So, what is SEHD really? It's the Schwab US Dividend Equity ETF. It tracks the Dow Jones US Dividend 100 Index. That means it's following a strict set of rules. No hype, no guessing. Only companies with at least 10 straight years of paying dividends can even qualify. They need a market cap of $500 million or more. They must meet liquidity standards. No single stock can be more than 4% of the fund. No sector can be more than 25%. And the index looks at return on equity, free cash flow, dividend growth, and the sustainability of those dividends. The fund rebalances quarterly. It fully reviews its composition once a year. If a company slips out, it's out. If a strong candidate shows up, it's in. Right now, there are about 100 holdings. Names like Texas Instruments, Pepsi, Chevron, Cisco, and Coca-Cola. The expense ratio? Just 0.06%. That's $6 a year on a $10,000 investment. And since launching in 2011, SEHD has averaged around 12.3% annual returns. Not bad for a fund designed to focus on quality, stability, and income, rather than chasing whatever's trending. Chapter 2. The misunderstanding. Underperformance equals risk. Here's where many people get it wrong. They see SEHD underperforming in 2025 and think it's suddenly risky. Let's break down why that's not the case. Earlier this year, the fund went through its annual reconstitution. It increased its energy sector weighting from around 11% to about 20%. Energy companies pay strong dividends, but they can be volatile. Meanwhile, SEHD has only about 10% in technology. That means it didn't fully ride the AI-driven tech rally. Funds like DGRO and FDV have more tech exposure, so they've outperformed recently. Another factor? SEHD leans on mature, slower-growing companies, like Coca-Cola and Pepsi. These aren't double-in-6-month stocks. They're pay-you-for-decade stocks. So yes, in a tech boom, it might lag. But in a downturn, those same slow and steady names can hold up better. Underperformance in one cycle doesn't equal long-term risk. It just means the market is rewarding different traits right now. That's why judging SEHD by a single year's return is like judging a marathon runner by their first mile. Chapter 3. The real risks in SEHD. Now, let's be clear, SEHD is not risk-free. It's just that its risks are often misunderstood. First, it has no international exposure. Every single company is US-based. That means you miss out if overseas markets boom. Second, sector concentration. Right now, energy is a big chunk, around 20%. That could help if oil prices stay strong, but it could hurt if they fall. Third, mature company bias. These firms are solid, but they're not going to deliver explosive growth. You won't see a sudden 50% gain in a year from most of them. Fourth, taxes. Those quarterly dividends are taxable in regular brokerage accounts. Yes, they're mostly qualified dividends, taxed at lower rates, but still taxable. A Roth IRA or other tax-advantaged account can help you there. And finally, Dividend cuts are possible in a severe recession. SCHD's track record is strong, but even the best companies can stumble. So, the risks are real. But they're clear, measurable, and, for many investors, manageable. The bigger mistake is thinking it's risky just because it's not keeping up with tech-heavy funds this year. Chapter 4. The Stability Story. Let's talk about stability, because that's where SCHD quietly shines. From its launch in 2011 to 2025, SCHD's price alone is up about 221%. That's without even counting the dividends. Add those in, and the total return is even stronger. Its dividend yield right now, around 3.8% to 4%. But here's the kicker. It's not just paying, it's growing. For years, SCHD has increased its dividend at roughly 10% annually. That means your income stream gets bigger over time. If you bought in 2015, your yield on cost is around 8% today. If you bought at launch, it's closer to 12%. And in rough markets, in 2022, SCHD fell only about 3%, while the S&P 500 dropped around 18%. That's the benefit of holding quality companies. These are businesses with solid free cash flow, strong balance sheets, and long dividend histories. So while it may not always top the charts in bull runs, it has a history of holding the line when things get messy. And that's a form of risk management you don't see in the performance charts. Chapter 5. Why it's misunderstood. So why all the confusion? It comes down to expectations. People buy SCHD and expect it to beat the S&P 500 every year. But that's not its purpose. It's built to deliver steady income growth from quality US companies, not to chase the latest momentum play. When tech stocks are soaring, SCHD will probably lag. But when markets stumble, it can hold up better than most. Another reason it's misunderstood, its reconstitution process. Every year, it swaps in stronger companies and removes weaker ones. That means SCHD in 2025 looks different from SCHD in 2020 by design. It's not broken when it changes. It's doing exactly what it's supposed to. The problem is, many investors only see short-term performance and assume something's wrong. In reality, it's just a different kind of game. Chapter 6. Who SCHD is actually for. So, who should own SCHD? First, income seekers. If you're in or near retirement and want to live off dividends without selling shares, SCHD can deliver that. It pays quarterly, and it has a long history of raising those payouts. Second, dividend growth investors. If you reinvest those dividends through a DRIP, your share count grows, your payouts grow, and the compounding effect kicks in. Third, long-term, set it and forget it investors. You don't have to track earnings calls or monitor 50 companies individually. SCHD's rules do that for you. It's low cost, it's disciplined, and it's diversified across sectors like industrials, healthcare, and consumer staples. Who is it not for? Traders looking for 40% gains in a year. People chasing the latest ETF with a flashy yield, or anyone who can't hold through periods of underperformance. SCHD works best as a core part of a balanced portfolio, paired with growth funds if you want more upside. It's for investors who understand that slow, steady, and consistent can still win in the long run. Chapter 7. Practical takeaways for investors. So, what can we actually take from all of this? First, know what you own. SCHD is value, quality, and income. It's not a high-growth tech ETF. If you expect that, you'll be disappointed. Second, think about taxes. Those quarterly dividends are taxable in a normal brokerage account. Yes, they're usually qualified dividends, taxed at lower rates, but still taxable. A Roth IRA or other tax-advantaged account can protect that income. Third, reinvest if you can. If you don't need the cash now, turning on a DRIP means your dividends buy more shares automatically. Over years, that's powerful compounding. Fourth, build balance. Pair SCHD with growth ETFs or international exposure so you're not leaning too heavily on one style. Fifth, stay patient. This isn't a check every month type of holding. It's more of a check every few years investment. Because the real story with SCHD shows up over decades, not months. And finally, remember, its job is not to win the race every year. It's to help you finish the race with steady, growing income and fewer surprises along the way. So here's the bottom line. SCHD isn't risky. It's just misunderstood. Short-term lag doesn't mean long-term failure. It means the market is favoring a different style right now. If you want a fund that can give you income, stability, and growth over decades, SCHD can play that role, but only if you let it. The real risk isn't in the fund. It's in expecting it to be something it's not. Match it to your goals, stick to the plan, and stop chasing the scoreboard. Because in investing, the slow, steady, disciplined approach often outlasts the flashy one.